cpaacademy.org. My name is Vaughn Smith. I will be your moderator for today's webinar, Introduction to Annuities. And no, that's not me on the screen. That would be Carlos, our instructor for the day. I'm just the voice behind the guy, making sure everything is A-OK on this. And we're so glad you guys are taking time out of your day. Spend the next hour with us. We have some great information. So we really appreciate you all being here today. I want to make sure you can hear me. You can see the title slide and see Carlos on the screen. We'd like for you to say hello and tell us where you're tuning in from. That way I know everything's working. And it looks like you guys are already flooding that questions panel. So that's awesome. Thank you guys. It's going so fast. Let me pull out a few. We've got Arkansas, we've got California, we've got Mobile, Alabama, and Louisville, Kentucky. I don't know if I said that right. I'm not from that area. Louisville, is that how you say it? All right, guys, thank you so much for letting me know everything's working. If you're having any issues, just let me know here in this questions panel. I'll do my best to help you out as quickly as possible. This session does qualify for 1 CPE credit. You need to remain logged in for 50 minutes, answer our polls that will pop up throughout this presentation. Make sure you hit that submit button so it will register for your CPA credit. There are handouts available for this presentation. You're just going to give me 2 minutes after I'm done with my introduction to go ahead and put those into the system. So just hang tight. I will get those in as quickly as possible. When we're done, we'll get ready. We'll work on processing your CPE credits. That will be available. Your CPE credit will be available on your account. You'll also get the handouts and the recording. Questions for the presenter, go ahead and put those into the panel. If we don't get to all questions, he does receive copies afterwards so he can see items that may have been missed. So now help me in welcoming our presenter, Carlos Diaz. It is all yours. I turn it over to you.
Thank you, Vaughn. Thank you, CPA Academy. I appreciate everyone that's on this call today. Today's topic is Introduction to Annuities. It's a very high-level overview, and I will give you my presenter's page in just a minute, but I would recommend that if you like today's webinar and you have a lot more questions, that you sign up for our 1.5 hour. We just expanded that because of time and just so much content it's inside. Just a little bit about me. I'm a financial advisor. I'm also a writer for Kiplinger. I've written for MarketWatch, Forbes. I work as a CPA consultant. You have my website there at the bottom for more information. I would say this after today. If you have any questions after today's webinar and you want to reach out to me directly, you'll have my contact information in the next couple of slides. But if you have a case that you're looking at or you have second questions, please reach out to me directly. A lot of times I work either in the environment or also I work as a fee-based advisor as well, doing consulting services. And then here, of course, is my profile. You can just click the link at the bottom. We have a lot of great courses coming up. We'll have next week is an advanced look into annuities. And then you can connect with me. I'm on LinkedIn, Facebook, Twitter, Instagram. My direct number is on the bottom left and my email. So let's look at today's learning objectives. Today we'll define an annuity. We'll look at the different phases, how they're sold. We'll look at all the types of annuities as well as the pros and cons, the reasons to purchase an annuity, tax treatment of annuities, and then we'll open it up for questions and answers. And by the way, too, you should have these updated slides in your panel. And then there's also should be an article in there that I wrote for Kiplinger about a year and a half ago, actually a little bit longer. So here's some quick terms that you might hear me say, and so you know what they mean. So qualified, obviously pre-tax, non-qualified, post-tax or after-tax. Single premium, we're talking about a one-time payment, one-time deposit. Flexible premium is multiple or what they call ongoing payments. You have annuitization, which is converting into a series of payouts. And then you have annuitant, the person, the live body, with person with measured life. So let's define an annuity. It's a contract between an insurance company, a contract owner, and an annuitant. The insurance company accepts the premium. They issue a contract and they credit interest based on the terms of that contract. Simple enough, right? And then the contract owner that can surrender, withdraw, or convert into a stream of payments. Now, the conversion into a stream of payments, a lot of times that's perceived as annuitization, but there's also some other ways around it where you don't have to be quote unquote locked in. That's a lot of times when you hear about annuitization, people are saying that they're getting themselves locked in. So I put 3 phases of an annuity, but in reality, there really are 2. But I just wanted to talk about the third one. You have the accumulation phase, where funds are paid into the contract, interest is credited. You have the payout, funds are distributed. And then, of course, you have maturity. Maturity is where you have a non-qualified annuity, typically is like age 85 or 90, where you'd have to annuitize cash or be subject to immediate taxation. But there is a walk around, and I will discuss that in just a couple slides or a few slides. So accumulation, just if I could summarize this in one word, deferral. It's just building up the contract. It's typically the first phase for the majority of annuities. So fixed, index, and variable. Immediate, not so much, because typically immediate annuities are turned on the month after. And then most immediate annuities already start in the payout phase. So the payout phase, one word to summarize it, annuitization. It's the period that the annuity is being distributed from the contract. This second part is very important. So the owner annuitant can avoid annuitization and only use the withdrawal features from it via an income rider or penalty-free withdrawals. Let me explain that. So with index annuities and variable annuities, they have these income riders. We go into a lot more detail in the next course. But for all intents and purposes on this course, just know that as long as you're taking that income rider, that guaranteed amount, a lot of times that's often referred to, the contract is not being annuitized, and you still are able to exercise the guarantees inside of the contract. So guaranteed payments. And then, of course, you have the maturity phase. So again, usually age 85 or 90. These predominantly are on non-qualified annuities, because qualified annuities, so IRA annuities, they have to require minimum distributions. So if your clients were already 70 and a half before the Secure Act went into effect, or age 72. So the owner annuitant must either annuitize the contract, cash it out, lump sum, or be subject to taxes on interest. But the workaround is a 1035 exchange. So let's just say that you have a client, they've had an annuity for so many years, they've been building up a lot of interest in the contract, haven't taken anything, and they're about to hit this maturity phase. They can just essentially 1035 that contract into a new contract, avoid this altogether. So I always feel like it's important to discuss the history of annuities so you know kind of where everything is coming from. The immediate annuity is the oldest type of annuity that's out there. It's been at least since 225 AD, if not maybe even before. But these are just certain key points that I wanted to bring up. The fixed annuity, the important thing about the fixed annuity, in the 1930s, it was introduced during the Great Depression, Securities Act of 1933. Fixed annuities are not securities. That's the key part there. And then, of course, the variable annuity, introduced by TIAA-CREF in 1952. Technically, two other parts. I'll go over that last part in just 20 seconds. But you have the index annuity. It was created in 1995 by Keyport Life. It was an alternate to the variable annuity, which was overtaking the whole market. You have key points 1 and 2 at the bottom. You have Rule 151A that was proposed in 2008. And subsequently, in 2009, you had the final rule. I usually say by 2010, it was already done and over with, that index annuities are not securities. That's the key part there. There's still some people out there that think that indexed annuities, for some reason, are investments, but they're not. So how are they sold? So if you get nothing else from this webinar, know this slide. This slide's going to help you out a lot of times. So depending on the financial advisor or the insurance agent, you really can break it down into 4 different categories. You have your captive agent, which is your insurance only license. They can also be a broker or what they call a registered representative. By the way, if you want to know more about the terminology, we also have a Deciphering the Financial Advisors, the different types of financial advisors course. But they're classified as a registered representative or broker. It's really the same word. These typically work for your mutual companies for the most part. So my background I usually give is I started off working with Bankers Life and Casualty, and then I worked for 6 months at New York Life. Now, Bankers Life and Casualty is not a mutual company, but they're still probably one of the very few companies that are out there that are non-mutual. Your mutual companies are New York Life, Northwestern Mutual, Mass Mutual, etc. The types of annuities that they'll sell you are immediate, fixed, variable, and some have index annuities. So they've just been introducing those products into the marketplace. And then you have your straight broker / registered representative. They typically will work for a brokerage firm. So these are like your Merrill Lynch, Morgan Stanley, Edward Jones, etc. I would also classify this as a bank financial advisor. It's essentially the same thing. Their typical go-to is variable annuities, although they do offer fixed annuities, and then they do also offer very few index annuities. So for instance, one bank that I recently did a review on a client, the bank only had access to 2 different companies. Then you have your independent insurance only license. Typically will sell immediate, fixed, and indexed annuities. Because they are only insurance licensed, they will not get into the variable annuity market. The problem with the independent insurance only license, I know that sounds very good, but a lot of times agents, especially, there's a laziness component, and they only get caught into 1 or 2, 3, or maybe 4 insurance companies. And those are the go-to ones all the time. When products are constantly morphing, changing, now we're experiencing obviously lower interest rates, so some products are even incorporating a fee, something brand new. So things that you have to watch out for. But if you have these independent insurance only licensed individuals that are out there just selling essentially the same thing that they've been selling for the last 10 years, that does absolutely no justice. And then you have registered investment advisors. You have those fee-only variable annuities. A lot of times they might use the terminology as no load or no surrender charge. That's the key word there. And depending on the type of annuity, so immediate annuities, fixed annuities, and index annuities are sold through contract. The only caveat with the index annuity is that the lifetime income rider is also a contractual guarantee. The variable annuity is sold through prospectus, so the risk is essentially put on the client. However, if the contract is purchased with a lifetime income rider, then there is some sort of contractual guarantee. But a lot of times I like to explain this as if you have an income rider and your annuity has been losing money and you've also been withdrawing from that income rider, you're essentially going to get back down into the zero very, very quickly. You're essentially at that point annuitizing it. And I know for a lot of people this is going over their head, but you're essentially locking yourself into that contract at that point. So what I like to say is use annuities for what they're designed to do, and a lot of times I recommend not even using the variable annuity at all. Oh, okay, so we have our first polling question. Let me go ahead and launch that, and I'll read it to you. Who are the parties to an annuity contract? So the choices are the insurance company, contract owner, and annuitant. A, only insurance company. B, insurance company and contract owner. C, contract owner and annuitant. Or D, insurance company, contract owner, and annuitant.
While you guys are answering that question, I'm just going to pop in really quick just to Do a few housekeeping. Just know that we will have 4 polls total. We keep our polls open for about 60 seconds to allow you to get your votes in. So make sure you hit that submit button. If you're having any issues, just let me know.
We have about 10 seconds. Three, two, one. Go ahead and close this out. All right. So 82% are correct. The answer is D, insurance company, contract owner, and annuitant. One key piece that I missed out is that the reason why it's these 3 parties is because technically a trust, and let me just be a little bit more specific, an irrevocable trust, which is its own entity, can be the contract owner. So you need, in that situation, you need an annuitant, a person with measured life. So just to clarify, you can have a trust as an owner. Let's look at the 4 different types of annuities. You have immediate annuities. That includes your qualified longevity annuity contract, or QLAC for short. And you also have your Medicaid SPIA. I'll go a little bit more into detail. Fixed annuities, variable annuities. You have their offspring buffer annuities, which coincidentally I also missed in the history of annuities, the buffer annuity, which we'll go over as well too. And then index annuities. Sometimes they're referred to as fixed index or equity index. So immediate annuity, funded with a single premium. Majority of the time offers the highest guaranteed payment that can be structured for the rest of the annuitant's life. And the annuity itself may even refund any what they call leftover payments that haven't been made. It's a feature that you have to put onto the contract. Most likely it will not keep up with inflation, and if you structure it incorrectly, the beneficiaries may not receive the remaining balance. So that's the key there. You have to structure it correctly. Out of all the different types of annuities, it has the least amount of control, or what they call flexibility, because immediate annuities cannot be surrendered, only sold in the secondary market. So if you ever hear a commercial on TV, I have an annuity and I need cash now, call, that's what they're referring to. It's for an immediate annuity. On a side note, a lot of the car accident annuities are structured with immediate annuities. So the 3 main different immediate annuity payouts, they're life, you can choose single or joint life, period certain for a set amount of years, and refund. And really there's a ton of combinations that you could do inside of these. The more contingencies that you put on the contract, the less of a payment you receive. Simple. Again, all the different types of payouts. You can just read through these. The QLAC was specifically created to defer required minimum distributions. Essentially, you can defer up to age 85. Let me break it down for you. It's either 25% of the IRA balance based on December 31st, or a maximum of $135,000. And this would be based on a balance of at least $540,000. So let me give you 2 examples really quickly. Let's just say if you have a client that has $100,000, they cannot opt with the whole $100,000 in. It's the greater of 25% or $135,000. So in that case, it would be $25,000. If you had a client that had $1 million, the maximum they can put into the QLAC is $135,000. You have the Medicaid SPIA. I'll go a little bit more into detail into the next webinar on the Medicaid SPIA, but just know it's just meant to qualify an individual for Medicaid long-term care assistance in their corresponding state. And of course, before you ever want to turn on a Medicaid SPIA, you want to make sure that you check the state's Medicaid laws and you use a qualified elder law attorney. Typically, a lot of these recommendations come from elder law attorneys. For a person that's healthy, there is no need whatsoever for a Medicaid SPIA. It's just, again, a tactic to qualify for long-term care assistance. I break down all annuities into pros and cons. The pros typically offer the highest payout, although I'll give you a recent scenario, and actually for the last 6 months, if not longer, there are a lot of immediate annuities that are out there that their payments are not even as high as other types of annuities with income riders, and you're locking yourself in. So the idea is you want to get a quote and kind of compare with everything that's out there. But for the most part, for general information, obviously we're in a low interest rate environment now. In general, immediate annuities typically offer the highest payout. That's why we use the word typically. The payments don't ever change unless it's a period certain, and you have multiple payout options. You can choose from life, joint life, period certain, and even refund. And there are no surrender charges. But the cons typically do not keep up with inflation. It's a possibility of losing the remaining balance because the life option is chosen and you have premature death. A lot of times we've heard about this through different blogs and different TV people that say that somebody in their family started an annuity and then they passed away a couple months later and the insurance company kept the balance. That's what they're referring to is this option. But again, it all goes back to the structure. If you structure it correctly, that's the key there. I also like not to name names too much, but there's another person that is on TV a lot, and I recently went through her blog, and she discussed about why she did not like annuities. She implied a lot about an immediate annuity, although she didn't call it out specifically. But even the structure inside of the blog was completely incorrect, and I'll probably be writing an article about this in Kiplinger. But there's just a lot of misinformation that's out there on annuities. Loss of control because it cannot be surrendered, so as opposed to other types of annuities, and the only option is to sell in the secondary market. Fixed annuity, you can fund it either with a single or flexible premium. Simple enough, plain vanilla, offers a fixed interest rate over a set period of years. A lot of times they use the term CD alternative, and you'll probably see it in the next slide, the next couple of slides. And just a really quick example, let's just say you found an annuity, fixed annuity specifically, that earned 2.5% for the next 6 years. The owner or annuitant can choose to take a shorter or longer term contract. The pro in this case is that the insurance company cannot modify the interest rates, may or may not keep up with inflation, and the owner annuitant is committed to the set period, regardless of economic fluctuations. So right now it's a positive, but it can be a complete negative if you get locked into something right now and interest rates just jump up. But for the most part, let's just say someone that had or took out a fixed annuity contract in the last few months, they're at a much bigger advantage than they are right now. Term CD-like is often used. What they're typically referring to, the name of this type of fixed annuity, it's called a MYGA. There's different types, and you need to make sure that you read the contract correctly. But for this one is the MYGA multi-year guaranteed annuity. You can choose a term as low as 1 year. Most are 2 to 5 that I structure. And high end is about 14, maybe even 15 years. They use a market value adjustment. We go over what a market value adjustment is in the next webinar. But the term I use is MVA, or sometimes what I say is maybe valuable afterwards. The pros on the fixed annuity, there can either be short or long-term contracts. Insurance company cannot modify the interest rate. Predictable interest, and a lot of them offer the 10% penalty-free withdrawal, or at least the interest, as opposed to maybe a CD that doesn't offer that. They can be turned into an immediate annuity through annuitization. Important part about this is that even though fixed annuities, index annuities, and variable annuities are not immediate annuities, know that you can still turn them into an immediate annuity. The cons: may not keep up with inflation, you have the time commitment, the liquidity features, surrender charges, and then you have the 10% early withdrawal penalty if under age 59 and a half. In general, this applies to the IRA no matter what, but what I'm specifically saying about this is a non-qualified fixed annuity outside of the IRA. Let me go ahead and launch the second polling question, and I will read it to you. Which of the following statements is false? Annuities are issued by insurance companies. A. B. Immediate annuities have surrender charges. C. Fixed annuities have surrender charges. And D. Fixed and immediate annuities can be annuitized. So about 10 seconds. Three, two, one. Close it out. And 39% of you said the answer was B. That is the correct answer. Just remember that immediate annuities don't have surrender charges. They can only be sold on the secondary market. And that's either partial or fully, just to kind of add to that. And I know we're going over a lot of content, but again, immediate annuities can only be sold on the secondary market. The indexed annuity, it's a single or flexible premium, although that the marketplace for the flexible premium indexed annuity is probably very limited right now. It credits interest based on the performance of a particular stock market index, so for instance the S&P 500, but it doesn't actually participate in the stock market. That was the key part to Rule 151A, because they were coming out with, well, it participates in the stock market, but it really doesn't. And we'll go over that on the advanced course. The minimum these will typically credit is 0%. So a lot of times you'll hear maybe terminology like zero is your hero or the floor is zero. That's what it is. But in actuality, you have to look at the minimum contract values. It's typically 1 to 3%. But for all intents and purposes on this webinar, the minimum that these will typically credit is 0. So you have years that has a negative return, it doesn't credit anything back. The payouts, they can be structured similar to an immediate annuity without annuitization. The interest depends on the terms of the contract and the index the owner or annuitant is tied to, and they will not receive all of the stock market index returns. Very important. A lot of times you will have agents that go out there and pitch this as get all the gains without any of the losses. It's not true. It's just a selling pitch. Limits and participation rates will vary from one insurance company to another. This is a very important key point, because if you think about it, you want to make sure that you use an insurance company that has a good track record. And if you have a company, for instance, that just got into the market, especially into the indexed annuity market, and then all of a sudden we're experiencing what's going on right now, the first thing that they go after is they drop the participation rates, the amount that this contract can earn. So make sure to use a company, and again, go through the contract, but you want to use a company that has been well established, has been out in the marketplace, has a track record. Be very careful with what I call proprietary indices or indexes, or the term is back testing or back casting. What this does a lot of times is what I call the illustration manipulation. And there's currently one insurance company that's going through a lot of issues because of this. They illustrated double-digit returns, and then 6 years later or more, when these contracts have not produced high single, clients are very angry because it was not what they were illustrated. Same thing happened with life insurance. So you have to be very careful when they're showing these proprietary indexes. And of course, there's also a market value adjustment on these as well too. Although not all of them but for the most part. And really, the market value adjustment can be your friend. And I will go over it in the next webinar. But essentially, if you took out an index annuity years ago, has a market value adjustment, interest rates were a lot higher, and today's interest rates are a lot lower, and it hasn't been performing the way that you want it to, even though you have a surrender charge, you actually may be in a positive interest environment that you can just go ahead and just exchange it or just get out of it altogether. The pros: principal is protected from the stock market exposure. Again, payouts can be structured without annuitization, although you can still turn it on. You can turn it into an immediate annuity. The interest is typically higher than a fixed annuity. Index annuities were meant to compete with fixed annuities. They're not meant to compete with variable annuities because, again, they're not securities. The surrender charges, a lot of times we bring that up as a con, which it is. And everything really depends. There's a lot of misinformation on surrender charges as well too, but you can choose from index annuities that have a low surrender charge period. The con with the lower surrender charge period is what the insurance company might give, the participation rates, etc. But the cons for the index annuity: do not receive all of the index returns. The renewal participation rates and caps might be lower than other annuities. And again, this has to do with the insurance company that you or your client have chosen. There are surrender charges if the contract is terminated. And of course, you have the 10% early withdrawal penalty under age 59 and a half in a non-qualified annuity. And I will give you a story about this as well too. So a lot of times I've seen clients that have come in that, their advisors are showing these illustrations that are using back testing, back casting, or they're also cherry picking certain time periods in the market. And I know for sure that the annuity will not do that, but it just illustrates really well. So just, again, be very careful with that. The variable annuity. I'm also including a SEC guide to variable annuities at the bottom. We will cover a lot more in detail in the next course, but you can use a single or flexible premium. The annuity can experience the greatest amount of earnings and losses due to the market exposure. Depending on the performance of the sub-accounts, which are the investments, the owner annuitant can receive a higher payout as a result of market exposure. Let me explain that. Let's say that you purchase a variable annuity with an income rider, and let's just say that the income rider grows at a 7% percentage rate. It's not an interest rate, by the way, and often these contracts are sold that way, and I'll go over the next webinar, but let's just say that you're sold with the income rider feature that has a 7% percentage rate that's growing on the income side. Well, essentially, your accumulated value, which is the other side of the formula, can grow a lot higher because it's exposed and at risk. And so in a time period, it can grow a lot higher than the income account value, which essentially will give you a higher income payout. The problem is you have to catch these at the right time, and not a lot of people do. Of course, you have the fees, which we'll go over in just a few minutes. But the other part is, let's just say if you did have that positive aspect of it, and you were able to receive a higher payout because you put a lot more exposure on the annuity itself. Once you start taking withdrawals from it, and once you start having losses, because at some point or another they will experience losses, that will eat into the contract a lot sooner. And this is where I talked about earlier, where essentially once your account balance gets down to zero, it essentially turns into an immediate annuity at that point, and then you're locked in. So I would look at maybe the variable annuity more for growth and try to limit the fees as much as possible. That'll be the biggest killer in these contracts. But I like to use annuities for what they're for: protect principal, offer guarantees. The owner annuitant receives all the interest credited, and the payouts can be structured similarly to an immediate annuity without annuitization, again, through the income rider. But you do have these fees: mortality expense, administrative, sub-accounts, and annual service charges. And they can average anywhere from 3 to 5%. In one scenario, I saw over 5%. It's insane. So let's look at a variable annuity averaging 2.5% for 6 years. Obviously, the much better route would have been the fixed annuity. You have the term buffer or variable annuity or variable indexed annuities. That was the last part of the history that I wanted to throw in there. Because the indexed annuity market was just gaining so much popularity with sales, the variable annuity market at one point needed something to kind of add some sizzle. And really what they did was they created the buffer, which would limit part of the losses. You can choose a buffer that maxes out at losses maybe at 10% or 20%, but it will also limit the upside as well too, which is the reason why you would get into a variable annuity. Essentially, if I were to choose a variable annuity, I would not choose a buffer annuity, but again, it's just meant to give it a little bit more a different aspect or a different feature. You do have the managed or the fee-only variable annuities. They eliminate the fees and the surrender charges. The key part with the variable annuity is that your value can be less than what you started, even when you don't have a surrender charge. So let's just say, for example, you started with $100,000 in a variable annuity, the surrender charge is for 7 years, and now you're 7 years out and it's experienced market losses, and not only that too, but you have the fees that are inside of it. It's very costly. Now your annuity is only worth $80,000. Essentially, if you wanted to cash it in, you'd only receive $80,000 at that point. The only way that you'd be able to recoup the $100,000 is through death. It's the only way. You'd have to pass away. Your beneficiaries would receive that initial balance back, assuming no other withdrawals were taken. Pros: receive all the interest credited. Payouts can be structured without annuitization. Again, the income rider that you can add on to these. Possibly a higher payout with sub-accounts and investment options. And they can be turned into an immediate annuity through annuitization. The cons: fees are typically 2 to 5% a year. You have the risk of losing money, pass away to receive the principal, surrender charges, 10% early withdrawal penalty if under age 59 and a half on a non-qualified variable annuity. Let me go ahead and launch the third polling question. Which is the only type of annuity that involves risk? A, immediate annuity, B, fixed annuity, C, variable annuity, or D, indexed annuity? So 10 seconds. 3, 2, 1. Close this poll out. And 71% said the answer was C, and that is the correct answer. And by the way, too, the polling questions are meant just to give a little bit of an idea of what's out there. There's a lot of information. Again, there's a lot of misinformation on annuities. So I don't expect everyone to be a guru after this call, but at least it opens up the door to ask more questions and to be able to review things. So let's look at the reasons to purchase an annuity. Principal protection, probate avoidance, guaranteed lifetime income, tax deferral, a bond alternative, long-term care, very important key feature. Actually, tomorrow's webinar on the introduction to introduction to long-term care, we'll be going over the long-term care annuity a little bit. The key part of this is the 2006 Pension Protection Act, which went into effect in 2010, allows you to essentially exchange tax-free an annuity for a long-term care annuity. It has to be a qualified long-term care annuity. This is very important for those that have a lot of gains in their current annuity and then need long-term care. Asset protection, and I would probably also take it another step and say money mismanagement. So let's look at Social Security taxation. So what I'm going to use in this example, because the other part that we can use an annuity, especially a non-qualified annuity, is to minimize Social Security taxation. Now, a lot of you already know how to find out the percentage of Social Security that's taxed, but you have that slide there, and that's what we're using in this example. Let's just say we have a single retiree, age 66, with taxable interest. They received money from a pension, $29,200, another $21,400 from Social Security, and then their interest income, which CDs, money market, and savings account, totals about $16,800. Their total interest income in this example is $16,800. Their provisional income is $56,700. They are in a 22% marginal tax bracket, or 10.66 average. The amount of Social Security that's taxable is $18,190, and then the tax due on the Social Security alone is $4,002, but the total tax is $7,184. This does not include state income tax. And what we said is, how about if we just redirect that into a tax-deferred annuity? So we still have the same pension income and Social Security income, but as you can see in this example, the interest income is zero because it's tax deferred. It will bring down the provisional income to $39,900. The client is in a 12% marginal tax bracket, or 5.85 average. The amount of Social Security that's taxable is only $9,515. Very important because the tax due on that is only $1,142, a 71% decrease alone. The total tax is $2,960. Again, not including state income tax, but it's a 59% decrease. And I know a lot of you are probably saying, hey, Carlos, but at some point or another, the annuity, you'll have to pay tax on it. And that is correct. But the important key feature of the annuity is that you can choose when to start taking income from it because of the deferral on it. You're not required. And again, if you do hit a portion where you get into maturity, you can just exchange it. And in certain scenarios, let's just take this example and take it a step further. Let's just say that you had this example and you had a client that said, you know what, I really don't need the gains from the annuity. I don't need it for anything at all. Just like I had someone that reached out to me, and their biggest concern is that I don't have long-term care, and at the same time, I don't want to pay tax on the interest that's earned. Well, then you can do a 1035 exchange into a long-term care annuity. And essentially, all the interest that you've earned, as long as it's used for long-term care, is tax-free. Asset protection, I'm not going to go into too much detail, but for instance, you want to make sure that you check with your state's asset protection laws and use an attorney. I have a 50-state asset protection guide. If you'd like, just send me an email, say, hey, Carlos, send me the asset protection guide. It's provided through a law firm. But for instance, in Florida, it's protected from creditors and lawsuits. And certain states they are, certain states they're not. But you just want to make sure that you check your state's asset protection laws. The other part that a lot of people do miss out on is the Medicare Part B premiums. So let's just say the adjusted gross income for a couple is $180,000. And let's just say that they could have brought that down to under $174,000 by just making some simple shifts on their income. Their Medicare Part B premiums would be at least $60 less. And coincidentally, I did go through this recently with a client of mine. Totally different scenario, was non-annuity, actually came from a pension. But you want to always watch out for Medicare Part B premiums because yes, taxes are important, but there's all these other little things that are going on, especially if your clients are 65 or older. And then of course you have net investment income tax, and then trust income tax rates. So the key part about this is that, and there's always a workaround on these, but let's just say that you have an irrevocable trust and the income that it produces out is over $12,951. It's not redirected to anybody. It's retained inside of the trust. Essentially the client will pay 30%, 37% on that income. The work around it, obviously using the annuity, is that since the interest is deferred, it's not like a dividend or anything else coming from a mutual fund or anything else. It's able to be retained and you have a lot more control. That's the whole idea behind these, the Medicare Part B premiums and the trust income tax rates. There's a lot more control with the annuity. The tax treatment of annuities. So Roth IRAs in general, they're tax-free if they're qualified. So age 59 and a half or older, you have the 5-year rule that they have the account for 5 years or more. If under age 59 and a half and the owner annuitant qualifies for an exception, the 10% penalty may be waived, but still taxed on the earnings. But for all intents and purposes, we're talking about non-qualified and we're going to be talking about non-qualified annuities. Non-qualified and qualified are taxed at ordinary income tax rates. What does that mean? So on a non-qualified annuity, the balance that you put into it is not taxed, but the interest that you earn on it is taxed at an ordinary income tax rate. Qualified annuities, straight up ordinary income tax rates because they're deposited with pre-tax, your traditional IRA. There's really no special tax treatment. Some people say deferral is special tax treatment, however you want to look at it. But it does allow the owner annuity to control when taxes are paid. Key part of that. And a lot of times we talk about the triple compounding benefit, so interest earned on principal, interest, and interest earned on money that would otherwise have been paid on taxes. Taxable versus tax deferred. So we're calculating let's just say a CD and a tax deferred annuity. That's how this is the formula how to calculate it, but here's understanding the power of tax deferral. So let's just say that you had an annuity that was a 3% rate of return. A comparable taxable account, one that you're paying taxes on, if you're in a 10% tax bracket would be 3.33. But look at this. If you're in the highest tax bracket that's out there, on just 3% alone, you have to earn at least 4.76 just to match. And let's just say the annuity would earn 4%. You're actually a little bit over 6% when you're in the 37% bracket. So very important with tax deferral. And then we'll talk about TEFRA. So, and first in, first out, and last in, first out. So before 8/14/1942, you had first in, first out rules. Principal came out first, not taxable, and then the earnings came out last. They were not subject to the 10% early withdrawal penalty. However, all annuities since after 8/13/1982, they're last in, first out. Earnings come out first, taxable, subject to penalty tax, and then the principal comes out last. It's not taxable. A lot of times people ask me questions as far as for income riders that are outside of qualified accounts. They actually operate under the last in, first out, and it's very bizarre with how they go about it, but part of it will start off being taxable, then it's not taxable, and then it ends up being taxable. So we'll go over that in the advanced course. Know this. So let's just say that you had a client that had a pre-TEFRA annuity, meaning that their earnings came out last and the principal came out first. They can still keep the same tax treatment. So again, if your client had a pre-TEFRA annuity and they exchanged it in today's marketplace, not that there's many of them out there, but they can still keep the same tax treatment. And then finally, let me give you some final thoughts because I really want to open this up for questions, and I know that we're very good on time. I went through a lot of the material a lot quicker, but annuities function very similarly to an IRA or 401k, but do not have the tax deduction or the tax-free withdrawal, unless, of course, the annuity is inside of a Roth IRA. And sometimes I get the question as far as for, should I put my annuity inside of my Roth IRA? And the answer to that is possibly. We have to understand the circumstances that go around that. Depending on the state the owner annuitant resides, it may provide asset protection. Again, these are for non-qualified annuities because qualified let's just say IRA or 401k annuities, already have its own asset protection built in. And this is the only vehicle left that has the ability to be stretched. So obviously the Secure Act got rid of stretch IRAs. If you have a non-qualified annuity, it still can technically be stretched, although probably for the most part, beneficiaries will take it within a 1 to 5 year period. The problem with annuities a lot of times is that the insurance agent puts commissions ahead of the right product. So instead of doing due diligence and putting together a report and going through all the differences that are out there, again, they obviously just pivot to certain types of annuities that they want to sell, or they just really look at commissions. I've heard things from just about everybody that's out there, and I've had situations where I've had agents say, you know what, I need to make sure that I make a good commission on this annuity. So it's really a problem when that happens. And really a lot of times the loyalty level is backwards because they often put themselves first or the insurance company first or second and put the client last, when in reality the client should always come first. Let's do the last polling question and we'll go over just one last thing. At which rate is interest tax on a non-qualified annuity? Ordinary income tax rate, short-term capital gains rate, long-term capital gains rate, tax-free. So you have 10 seconds left. 3, 2, 1. And 77% said that the answer was A, and that is the correct answer, ordinary income tax rate. Now, a couple last points. The American Institute for Economic Research said that if you have a couple that both attain age 65, there's a 50% chance that one of them will reach into their 90s. And there have been multiple times where I've seen a couple, both of them, they've reached already their 90s. So there's another reason on annuity as well too. The other thing that I wanted to bring up is this tax deferral myth, which I often hear regularly. The last time really it was 15 years ago, I would hear it a lot more. But it's this whole notion that you would never want to put an annuity inside of an IRA because an annuity is already tax deferred. It's already inside the tax deferred blanket, and then doing the IRA just doesn't make sense. I mean, it's just so much misconceptions that are out there. And I'll just put it like this. I would much rather see appreciating investments outside of the IRA, just because the appreciation and the step up in the basis, you're able to get a lot more opportunity. And of course, long-term capital gains rates are at historical lows. And really have the annuity a lot of times function inside of the IRA is a much better opportunity there. The other thing too that I often hear is the better deal myth. The better deal myth being that if I go to the insurance company directly, that for some reason I'll get a much better deal than going through an agent. So I will say, no matter who you go through, the rates will be the same. They're still going to pay the agent the same way. Going to the insurance company directly does not give any sort of interest rate positive. So. But again, here's my information. You can reach out to me, connect with me on social media. The easiest way to get a hold of me is to just call me. There's my phone number on the bottom left-hand corner, or send me an email. If you want to type into the chat box, if you have a particular case, just say, please email me or please call me. I will call you directly if you have something that you're looking at, or if you want a second opinion. A lot of times I'll have people reach out to me and say, hey, Carlos, what do you think about this? But let's go ahead and take some questions.
All right, Carlos, and I don't know, I actually forgot to ask you at the beginning, do you want me to pick out questions or do you want to read from the questions panel yourself? I couldn't remember which way we do things.
You know what? Let me open up the questions really quickly. Let's see what we have, and then
And there is that square with an arrow, so you can pop it out to make it bigger, because sometimes it's hard to read it all bunched in with a
there we go.
panel.
All right, perfect. Thank you. Okay, so Brian, first question is, what do you think of Dave Ramsey and his opinions on annuities? Well, in general, Dave Ramsey has a very skewed judgment on all different types of products. I feel as if there's an opportunity that certain products, whether it's life insurance or annuities, are a fit. But for the most part, a lot of these, what I call talking heads or people that are out on TV, they're trying to pitch either certain investments or certain companies because they advertise with them. And so a lot of times you have that getting in the way. The opinions just a lot of times aren't really worth what they're put out. What did you say about a 1035 exchange? Kind of a open question on that, but with the 1035 exchange, so you can avoid maturity, that's one. If you have an annuity with a lot of gains and you want to exchange it for another annuity, you can do that without incurring any tax. That's another aspect for 1035. And then the most important 1035 feature, I would say, is the long-term care aspect of it, where if you have an annuity with a lot of gains and the client does not need any of that interest, they're worried about paying tax on those gains, then they can turn 1035 it into a long-term care annuity. Make sure it has to be a qualified long-term care annuity. And all those gains that come out of it in the future will be tax-free. What is the typical expense ratio and fees associated with different annuities? We will cover that in the advanced course. If anything, I want to sell everybody on the advanced course that's coming up next week.
And what date is that on, Carlos? Because I know you have quite a few on the schedule, so I just wanted to make sure it was the right one.
I believe, let me look at my calendar really quickly. So,
yeah. Because we had a couple of people asking about the advanced course, and I can see all of your courses, but I just wanted to make sure I had the correct title before I put that into the
yeah. So the advanced course is next Thursday.
I just saw it.
Next Thursday from 10:30 to midday.
And I can put the details in the chat for you guys.
Awesome. Let me see if I can take a couple more questions really quickly. Who can you use to purchase an annuity that does not have a commission motivation? Ooh, that's a very difficult question, because a lot of times you might hear these the fiduciary financial advisors that are only 65 licensed to say there's no commission incentive because I have just only a Series 65 license, which I go over in the Deciphering the Different Types of Financial Advisors course you want to sign up for. But at the same time, they may not even understand how an annuity can be a positive thing. That's the other thing. It's a lot of times it's very difficult because there's always some sort of incentive from somewhere. So for instance, when I was at New York Life, they always wanted to push their company product first. And so that makes it very difficult, because are company products that you work for the best? No. But in some instances, they might be. My final thoughts on annuities and con lists is why Susie doesn't recommend these products. It is too hard for people to adequately assess these products and be able to compare them. So we will break them down in the next course. But I will say with Susie, and that's actually one of the examples that I gave earlier, is even her example, there's a story that she puts on her website that talks about Grace's story. Grace's story is completely inaccurate. There's a lot of false information inside that story itself. So to really just rely on one source, not always the best idea. Let's see if I can grab one more. Where can I research insurance company that offer these contracts? A lot of times I use at least 2 pieces of software to pull reports. That's the first step, but really a lot of it's from personal experience as well. So, Teresa, if you have any particular situations or scenarios that you want to run by me, you're more than welcome to. But a lot of these are from personal experience because the reports, again, can always be manipulated in a way to show that one particular insurance company is a lot better than other ones. But really, when you start breaking down certain items inside of the contract, such as if they're using a proprietary index, maybe they have a fee, really changes the dynamics a lot. And then finally, Terry, this will be the last question. The 1035 exchange on the long-term care annuity. You're asking if it covers nursing home or does it also include home health care? So the definition of long-term care, which we cover tomorrow, will be home care, assisted living, and nursing home. A lot of times, the way that I use these products is very important because nursing home is just so out of control. I want to make sure that I use these to adequately fund home health care and assisted living because my philosophy is that you don't want to overfund long-term care as well too. And so the majority of people use home care and assisted living more than they use nursing. And there's just some alternate ways of going about it. But we will cover that tomorrow's course, which is at 10 o'clock as well too. So again, I know that we just ran out of time. Reach out to me, call me, email, or if you want to just type into the chat panel, say, reach out to me, whether it's email or calling, that would be the easiest way for me to get a hold of you.
All right, awesome. Well, thank you so much, Carlos. And yeah, while I'm doing this quick little closing, if you want to have him reach out to you, go ahead and put it in the questions panel now. So again, thank you so much for all that great information, Carlos. Really appreciate your time and sharing your expertise. And to our audience, thank you for joining us. Definitely check out our schedule. You can see classes from Carlos and all our other presenters on our CPAacademy.org. We will process your CPE credits. We'll have that in your account within the next 24 hours. You have this recording, you have the handouts. Jump on over to your inbox because we have that evaluation. We want to know what you think. We welcome and appreciate your feedback. So definitely go ahead and put those great webinar and fantastic information into that evaluation. But for now, I think we are done. So we're going to say goodbye one last time. Hope to see you all in future webinars. Have a great rest of your day. Thank you.
Thank you.